So just an advisory to start things off, a plain language advisory for you. I'm going to tell you about my vision of Peyto today. I'm going to tell you where I think commodity prices are going to go. And of course, these are called forward-looking statements. And I'm going to be truthful, use everything I know about the industry and about Peyto to predict the future, but I'm likely going to be wrong on both accounts, almost certainly the commodity price. Oil and gas exploration and production is a risky business, so please do your homework before making any investment. And of course, don't blame me if it doesn't work out. So I thought I'd start today just reminding everybody what it is we believe in at Peyto. All of the Peyto staff are here today, and we have some pretty strong beliefs at Peyto. The first of which is we believe in natural gas. We have always been a company focused on natural gas. We truly believe we're finding and developing the cleanest, most affordable, most efficient, most dependable, most scalable fuel that there is. And we're developing that for Albertans, for Canadians, for Calgarians. It was minus 30 this past winter, and I'm pretty sure we would have all been a little colder had we not had it. And I also believe that everyone at Peyto knows that we're a real business. And like any other real business in really any other industry, it's designed to make money for its owners. There's a whole bunch of owners up here, in fact, and there's a whole bunch of owners out in the room today. And while we often talk about the technical aspects of our business, we talk about, drilling, completing wells, we talk about developing reserves, bringing on new production, we talk about marketing our products. But really, at the end of the day, it is the profits that the business generates that is most important. That's what defines it as a successful business. Because without profits, I don't think we are a real business. I don't think any oil and gas without profits is a real business, nor are we going to stay in business for very long. And lastly, we understand full well, every single person who works for Peyto in this room, that we work for you, the shareholders. It is our shareholders' money that we're investing. And it's our shareholders' assets that we're developing at the end of the day. They're the ones that own the reserves and the production that we're developing and selling. So I think we better be damn careful with that capital. That's the attitude we have to have. Because if we're not creating long-term value from it, I'm pretty sure all the shareholders in this room have better things to do with that money. So those are ingrained beliefs that we have at Peyto. And they carry us through our decision-making all the time. Now, lately, we seem to have an abundance of natural gas in North America, and the price of the commodity has been quite soft for some time. So you might ask yourself, why are we enduring bulls with respect to this commodity? And I wanted to spend just a minute or two going through a couple of slides talking about our enduring bullishness. So if we look at the really big picture, the population of our planet, for instance, which over the last 50 years has grown quite rapidly, the graph on the left. From 1965 to 2015, world population more than doubled, from 3.3 billion people to 7.4 billion people on the planet. And since people need energy to survive, it's not surprising that energy consumption followed suit, tripling effectively from 80 million barrels of oil equivalent per day to over 250 million barrels of oil equivalent per day. That's a lot of oils per day. World oil consumption alone, in fact, is expected to top 100 million barrels a day in the next 2 years. And I'm sorry to have to break it to all those in the green camp, but this concept of a carbon-free world with a growing population on the planet is highly unlikely. In fact, we're going to need more of every form of energy that we've got for a very long time. Really, even just changing the slope of the growth in energy consumption is going to be a gargantuan effort, really. We can only hope that renewable energy, in fact, becomes commercially viable enough, fast enough, and can grow to make up that shortfall that we're going to have with respect to our energy needs, let alone really start to displace any of the existing energy supplies that we've got. I think the best we can probably realistically try and achieve in order to make our air and water a little cleaner, and so we can potentially power maybe 10 billion people on the planet in the next 30 years, is just to try and change that energy mix. And that, of course, means using more clean-burning natural gas. which means the demand for natural gas should continue to grow. And that's what most experts are predicting. Now, speaking of clean burning, there's no question that natural gas is cleaner burning. It's at least 10% cleaner than oil from a production standpoint, and it's twice as clean as coal when it's consumed. Peyto's gas, mind you, is cleaner still. Our operations have 50% less environmental impact than the average natural gas producer in Canada, and we're continuing to improve upon that record. For example, we recently participated in an Alberta fugitive emissions study where they went around and measured fugitive methane emissions from natural gas well sites in the province. And they spot checked 69 of Peyto's well sites. And the findings indicated that our well sites emit 27 times less fugitive emissions than the average industry standard. So we're now not only the low-cost producer, we're the Mr. Clean of the oil patch. Anyway, getting back to the demand picture, here in North America, demand for natural gas has increased 25% since we began Peyto. Actually, most of that's occurred just in the last 10 years. And that trend's also forecast to continue. We have close to 100 BCF a day of annual permanent natural gas demand in North America. And when you consider that North American supplies are declining at close to 25% per year, that means we've got to find 25 BCF a day of new supply. We've got to find it first, and then we've got to develop it every year just to make up that decline. And that doesn't even address the growing demand. That's just current demand. So basically, we have to find 1.5 Marcellus shale plays every single year, and we have to develop it just to keep up with the current demand. Seems like a rather daunting task to me. And we're pretty good at it. Looking specifically at the Canadian portion of that 100 Bs, ours is around 10 BCF a day of demand. Our supplies, though, have been shrinking, just most recently here, kind of growing again. But that's really reduced the amount of net export capacity we have from over 10 BCF a day in 2005 to just 6 BCF a day now. And like the NEB does, I also suspect our demand is going to continue to grow as we convert more coal to gas, especially here in Alberta. That seems to be an initiative that everybody's behind. But I don't necessarily agree with their forecast of growing supplies. I think our supplies are going to keep shrinking because I think we're going to bump up against some significant pipeline capacity constraints here in the near future. And I'm sorry, but I don't personally hold out much hope for Canadian LNG exports, either off the West Coast or the East Coast. And considering the provincial election that's just happened in BC, I think that's probably even more tenuous. In the US, of course, their demand has grown as well, but their supply has grown even faster. Obviously, one of our directors, Brian Davis, has been working too well at that. When we began Peyto in 1998, the US was a net importer of natural gas, most of it coming from Canada. Now they're exporting as much as they're importing, which basically means they're self-sufficient. The 6 BCF a day that Canada sends down into the US, they're basically turning around and exporting to Mexico and out the Gulf through LNG exports. And despite the fact that we can't seem to get any LNG off our coastlines, the US guys have done a really good job. They've grown US LNG exports up to about 2 to 2.5 BCF a day in just the last 18 months. And the projections are that by the end of this decade, they're going to have grown that to almost 10 BCF a day of exports. And you add to that the Mexican pipeline exports, which are currently sitting probably around 4 BCF a day and are projected to grow to 7 to 8 BCF a day. So now not only do we have to make up 1.5 BCF of Marcellus gas just to backfill our own decline, keep our own demand satisfied, we've got a big export market that's going to demand maybe another one on top of that. It's a lot of gas that has to be found and has to be developed every year. And of course in Canada we're connected to that entire grid, that North American pipeline grid. So our plays, like the Deep Basin, like the Montney in Alberta and BC, are well connected to the entire North American market. And we get to take part in that growing demand and into that big decline that we've got to backfill. Of course, maybe for us it's minus a little bit of a transport fee. All of this demand growth, and when you combine it with all of the base declines that we've got to backfill, is one of the main reasons that we continue to be natural gas bulls at Peyto 20 years later after starting the company, or almost 20 years anyway. Our second fundamental belief at Peyto, and one that really forms the foundation, I think, of our corporate strategy, is that we are a real business. We believe we are a real business. And like any real business, our goal is to generate real profit, to make real returns on the capital that we invest in this business. Folks, I've been in this industry, I think, for 27 years now. The gray hair is starting to show it. And in that time, I've really observed that there's only, I'll call it 4 main business strategies that are employed by E&P companies in this business. Of course, they all claim to be real businesses. And we all know examples of all 4 of these, companies that fit into each strategy, and we can probably all agree that investors at times have made money on all of them. I group them into these 4 buckets, call them the 4 horsemen, if you will. There's, of course, your classic pump and dump strategy. Everybody's seen examples of that. You've got your growth at all costs strategy. Most E&Ps right now are chasing that strategy. Your chronic acquisition models. We've seen good examples of those, especially during the trust era. There was a lot of companies that were like that. And finally, a profit and returns strategy. And interestingly, only one of these strategies is really designed to last. The first 3 you also have to pair with an exit strategy if you really want to be successful. And it's only the profit and return strategy that creates real and lasting value, I think, and builds a sustainable business that can endure over time. So how do we measure if a business is real or not in this industry? There's lots of different drivers companies talk about, and anybody who's been to the AGMs this season has probably heard them all talked about. They're ones that different companies use to measure their success or promote their success, as the case may be. You hear things like production growth tossed out a lot. Lots of guys talk about their land capture. They talk about big wells that they've drilled. They talk about interesting looking metrics that they've got, like capital efficiency. And even, God forbid, there's the odd few that actually talk about earnings and profits that they've generated. If I told you that Peyto had been growing its production on a debt and dividend adjusted per share basis at 25% per year for the last 8 years in a row, does that mean we've been successful? Maybe. I mean, for a while there, the market definitely seemed to think so. Our share price traded quite closely to that graph, that blue line. But I'd also argue that we were very successful in preserving value by not growing, deliberately not growing production during a period from 2005 to 2009, even though it doesn't look like the market knew what we were really doing. What if I told you we've been growing our land base 20% per year, capturing brand new opportunities at that rate for the last 18 years? Does that mean we've been successful? Don't get me wrong, Peyto's lands are incredibly potent. Because of the multiple stacked horizons we've got, when we buy one section in the Deep Basin, if we've got multiple zones, it could be several sections of rights that we're getting our hands on. And you can stuff a ton of gas into just one section in the Deep Basin. Over the 18 years that we've been at it, we've developed over 3 trillion cubic feet of reserves, and that fits in just 250 sections. That's 8.5% of our land base. But unfortunately, last I checked, lands don't generate cash flow. They're a cost. So maybe capturing new lands isn't such a good measure of success either. Well, what if I showed you all the big wells that we've drilled? And we've got our share of big wells too. And all the great big production rates. Is that evidence of success? Not really, because we all know that production declines by its very nature. So one rate today is not the same rate tomorrow. And how much did all those wells cost anyway? Maybe they cost more than they're ultimately going to make back. I'm sure we'd all agree that losing money isn't the definition of success in this business. Or maybe we'll do some fancy math, right? We'll calculate some impressive metrics like capital efficiency. That's the yellow line on this graph here. We could show you how we've reduced the cost to add new production from 50,000 BOEs a day in 2005 to just 10,000 BOEs a day last year. Does that mean we've been successful? I mean, it must be. Look at the impressive production growth. That's amazing. Unfortunately, none of these things really tells us whether we've been successful. And does that entitle us to call ourselves a real business or not? I think a real business is successful by creating real value for its owners. That's the definition of it. And real value comes from profits and it comes from returns. And profits should be easy to see. That's earnings, or at least that's what it's supposed to be. And at Peyto, we've generated earnings in each of the last 17 years, and I'm going to go out on a limb and suggest we're going to generate earnings this year too. Kathy just smirked. But it's really when you compare the magnitude of the earnings that we've created to the dollars of capital that we've invested, that's when I think we get to start to say, hey, we've been very successful. Because when I look at a lot of our peers in the industry, both in Canada and the US, that's when this accomplishment really stands out. I can't find anyone who's generated more profit per dollar invested than we did over the same period. The only problem is, using earnings isn't always so easy, because not all earnings are the same. A lot of companies flow unrealized gains and losses through their earnings, or they write off assets one year and they show earnings the next, right? Or they make a lot of assumptions about their future costs that are used to create earnings that aren't necessarily real. Or worse still, they adjust their earnings for certain costs that they don't like. Stock-based compensation is a popular one these days. Sadly, all these new financial rules like IFRS aren't making profits easier to see. If anything, I think they're blurring the picture. Take your traditional path on a financial statement to earnings. We take real revenues, we minus real costs, we minus compensation, and then we take a charge for depletion, or the replacement of that produced asset. But now, because IFRS lets us choose, we can deplete our PP&E pool over our 2P reserves, which for most companies is dominated by a future estimate of reserves and a future estimate of capital costs required to develop them. So now depletion becomes a guess, and it rarely matches the true cost of replacement. So in the end, all these new rules have just made earnings a little fuzzier. So it gets a little harder to see that true profit. And that's why I've often pointed to a simpler way to look at it. Just simply compare what it costs you to build it, those new cash flow generating reserves, and what it costs you to produce them and sell them, and what do you sell them for. And what's left, of course, is the profit that both shareholders and employees get to share. In 2016, for us, that was $1.44 an MCF to build it. That's for land, seismic, facilities, drilling, completions, tie-ins, everything. $469 million of total capital. It cost us 76 cents to produce it out of the ground and sell it. And again, that's everything. That's royalties, operating costs, transportation, G&A, interest, the whole ball of wax. And we sold it for $3.18, which left us with 98 cents of profit. Or a margin, a profit margin, if you will, of about 31%. And by the way, out of that 98 cents, we paid the employees in this room 6 cents. Shareholders good with that? I know I am. And that's the way we've always done it. Last year, in fact, was our lowest cost to build it and produce it in our 18-year history. Just $2.20 an MCFE. So kudos to the team in this room that managed to accomplish that. And hopefully in 2017, we can do it even cheaper. And again, when we look at our profit this way and we compare it to the rest of the North American industry, our business starts to look very successful, as it should. Real profit is obviously really important. It's what funds the dividends to our owners. Without real profit from real earnings, dividends are not, nor will they ever be, sustainable. They end up getting paid out of debt and equity, and eventually they end up getting cut out completely. We've all seen examples of that in the last few years. Okay, so that's profit. It's not hard to see. What about returns? For that, we actually have to do a little bit of work for you. And it's work that we do every single year, and we show it to you. This is the analysis we do. We look at the rate of return of every single well we drilled. We use the actual capital costs, we use the actual results. Here's the 128 wells from our capital program in 2016 with an average rate of return of 33%. Full cycle, including land, seismic, facilities, all the capital that we spent. And not all wells were successful. I'm sorry to break it to you. Especially when you measure them from a returns perspective. And this is the tool we use to allocate future capital amongst all the different plays that we have to try and achieve the maximum possible return on your capital that we're putting to work here in the company. You could look at it differently. We'll sort it by area, for instance. Here's our Brazeau area and our Greater Sundance area. And it looks like Brazeau's a little bit better, but this is a little skewed because Brazeau right now is taking a little more infrastructure capital. And so we probably would level them out about equal to normalize for that. But over time, we would expect that the capital is going to shift from area to area as fields and their inventory mature. That's natural. 4 years ago, we didn't have a Brazeau, and now we do. But you know, while those field level returns and those capital allocations are interesting, I think they're still rather meaningless for the investors in this room. Nobody sends you guys an AFE to participate in a well. So you don't ever get to see the returns at that level. As investors, you only get to own stock, which means we need to see returns on capital employed, all the capital that was employed, after all of the costs have been accounted for. And last year, Peyto's return on capital employed averaged 6%, which was one of the highest in the industry, sadly. And much of that was because we experienced the lowest natural gas price in our history, in our 18-year history. But still, that's not good enough. We got to do better than that. 6% is not enough. And this year we will do better than that. And that means generating more earnings and more profits so the returns on capital are even greater. So that's how we measure profits, that's how we measure returns. How does that translate then into value creation for you, the shareholder, or you, the owner? Because at the end of the day, remember, we work for you. And we show you that too. Every year we lay this math out for you to show you how we've taken basically one of your dollars and turned it into two. And we should be able to show you how we've created that value regardless of whether the stock market is open that day. Or for the next 5 years for that matter. To do that, we look at the change in producing asset value. That's the assets that we have. And when we compare that to what it took to create that value. So let me run you through this math, and it's not too complicated. We take the net present value of the producing reserves before tax at the start of the year, and we adjust for the net operating income extracted in the year, and then the change in commodity prices, because we definitely want to be comparing apples to apples. And then we compare that to the value at the end of the year. And the ratio of value created to the capital that we used is called, or we call, the MPV recycle ratio. And in 2016, for every dollar of Peyto's capital invested, we created 2.9 new dollars of undiscounted value for shareholders. And over the last 10 years, that's averaged about $2.3 of new for every dollar of capital. And we use this math not only to show you the value that we've created, but we use it to justify why we should be able to continue to invest your capital going forward. That's how we show you that we're a real business at the end of the day, with real profits, with real returns, and with real value creation for our owners. And so it should not come as a surprise, really, that a real business is going to get recognized over time. Just as Peyto's been recognized over time. Over the last 18 years, we have the highest total return of any company traded on the TSX over that same period. Not just oil and gas companies, any company in any industry. So Warren Buffett is absolutely right. In the short term, the market may be a voting machine, but in the long term, it is a weighing machine. Now, I said at the outset I would talk about where Peyto's going as well as talk about where we've come from, so I should probably stop talking about the past and turn to the future. And while we aren't planning on just winging it, as Calvin suggests here, we will be sticking to our strengths. The first place we need to go is lower, and that's a tough job, but we're going to do it anyway. In any business where you don't control the price of what you sell, you have to focus on costs. That's always been our forte at Peyto, minimizing the cost wherever we can. Because we all know the low-cost producer wins out. The low-cost producer at the end of the day gets to be a price taker. And for next year, while we expect the prices might actually be a little higher, and with our hedges already in place they likely will be, in order to be more profitable, we're going to have to try and reduce costs even more. Our Q1 cash costs were 89 cents. That's not good enough. We're going to get those down. And at the very least, we're going to grind down on the costs we can control, like OPEX and G&A and interest. And our F&D costs of $1.25, that's a goal, a target. It's a pretty high bar. We get that, but we're going to try and get there. We'll set the bar as high as we possibly can, and then we'll try and jump as high as we possibly can. And in Warren Buffett terms, we need to do this to maintain our moat over the industry. In 2016, we did exactly that. We maintained more than a $10 per BOE advantage over the rest of the industry from a cash cost basis. But the industry's trying to grind their costs down too, and so we have to lower ours as well. We, of course, have to be wary of inflation. The rig count that we saw over the first quarter this year was too high for the commodity price environment we're in. I suspect it will taper off as the year progresses in recognition of the commodity prices that we have today. And that'll allow us to get back out in the field to conduct our capital program going forward at a reasonable cost, like we've seen for the last couple of years. The next problem we've got, of course, is pipelines in Canada. I mentioned I didn't think that supply would actually grow in Canada because we're going to bump up against some of these pipeline constraints. And right now, the current pipelines out of the basin are full, and they're overcontracted, in fact. We've got the Alliance line, the Trans-Canada line, and basically the Spectra line, taking the majority of gas that's being drilled out of the basin. That's 12 BCF a day, that's all there is. And this is going to result in shippers increasing their pressure on their systems because they're going to try and stuff more gas into the existing pipe. And it's going to result in more proration of the service because they've oversold the capacity that's there. And so we've had to take some steps at Peyto in order to mitigate some of these risks. We've taken on excess service for those periods when we see there's going to be a lot less capacity than there is going to be demand, like in August this year coming up. And we've installed extra infrastructure where we need to handle the higher pressure requirements. And I think this situation is going to exist for some time, until either the upstream system's expanded or the supply declines. Fortunately, TCPL has now got some motivation to expand the upstream because they've signed their main line to a bunch of producers. But it's still going to take them quite a bit of time to expand the capacity of their system. But these cost pressures and these egress challenges, they're nothing new. We've had these challenges before. But we're going to continue to be smart and protect our investors by coming up with ways to reduce the risks, like we always do. More importantly, we've got some exciting new things to talk about and to focus on, like our Brazeau area. Last year at the AGM, I showed you the Brazeau area. I said it could be potentially as big as the Greater Sundance area one day. And indeed, it's growing. We recently added a bunch of new land with a bunch of opportunities here. We're eager to get out and get on those opportunities to generate some return for you there. But we have to be a bit cautious. Well control in this part of the basin is pretty sparse, and we need to make sure that we have our geology pinned down and well defined before we get out drilling horizontally through it. But overall, I'd say the entire team is pretty excited about this new area that we have to develop. So after breakup, we're going to get it back out in the field, and hopefully breakup's a lot shorter than it is normally because we've got a lot of work to do. We're going to be back out in our Greater Sundance and Brazeau areas. We're going to be completing and tying in some of the backlog of completions that we talked about in our Q1 release. We've got 9 rigs we're going to get up and drilling again. And we're going to combine that capital activity with a continued focus on driving down our costs. And so the results should be another great year for Peyto, with substantial profits, substantial returns, and substantial value creation for every one of the owners in this room. It's the path that we've been on for several years, and I suspect it's going to be the path we're going to be on for several more. I've been up here talking to you for over 30 minutes, so I'm sure everybody is getting tired of listening to me, and I could stand up here for hours talking about Peyto and why I believe it's the best company in the world and why I believe we've got so much future. But I'll stop. How about? And maybe we can open the floor up for some discussion.